Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's January 4th, 2019, episode number 9. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for taking the time out to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple of beers to talk about the week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
The show is broadcast as both a podcast and on YouTube. So if you're enjoying this as a podcast and feel like you're missing out on the charts or videos that we're referencing, you can register at markethuddle.com website to get the weekly email, which includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we have a special treat with Brent Johnson from Santiago Capital joining us. He will be telling us what he thinks was the most important development in the markets this week. Then we will try to get a trading tale out of Brent. From there, Patrick and I will discuss the mini flash crash in the FX market. And in our This Week in Trading History segment, we look back to the incorporation of Apple Computer Company. For this week's WTF Clip of the Week, Cramer teaches us about bear markets.
And we're going to end with the 5 most important things to watch next week. So let's jump right into it.
So, Patrick, who's our sponsor this week?
This week, our sponsor is the All or Nothing Brew House. I thought this was an interesting choice because it sounds like one of your trades, doesn't it?
Yeah, it does. Let's have a taste. And actually, Brent, why don't you say hi while we're doing this? And Brent, you can dip into your All or Nothing Brew House as well.
Sounds good. Yeah, looking forward to talking to you friendly Canadians.
You know, it's very fitting that as you chat with the friendly Canadians that we're drinking a couple of brewskis.
That's right.
Oh, it
okay,
is.
so...
Now, so Kev, why don't you do your little disclaimer thing, get it out of the way.
Yeah. So clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. So Brent, welcome.
Thank you for having me. Looking forward to talking to you guys.
It's terrific. You're our first guest, so it's quite an honor to have you, and we're looking forward to it as well.
It's all downhill from here.
So let's jump to it. What do you think was the most important thing, development this week?
Well, it's kind of interesting. I think a couple things that really stood out to me. One happened on the first day of the week, which was actually the last day of the year, on Monday. And then the subsequent reaction, I guess, or not subsequent reaction, but the follow-on this week is, one of the things I was really watching very closely going into the end of the year was the gold-silver ratio. I think we have a chart of it somewhere. Let's go, if you can scroll down a slide. Right here. So that's the gold-silver ratio on a monthly basis. I think we also have it on maybe a yearly and a quarterly basis as well. But basically, the purple line on these charts has been used a lot over the last year or so, especially over the last year as the ratio rose, to say that this is this is where we're going to see the bounce in the metals. That's the historic extreme. Go much higher than that, and you're going back to the all-time high of back in the early 90s, late 80s, early 90s. And so a lot of people have said that's where the metals are going to bounce. I see it a little bit differently, to be honest, because my view is that once you get past there, there's nothing stopping it from going to the all-time high.
Okay, Brent, sorry to interrupt. Let's just tell the listeners what they're looking at in terms of this is the ratio of gold to silver. So
yes.
as it's rising, that means the gold is outperforming silver. Is that correct?
That's correct. And normally, when you would get into a precious metals bull market, you would expect to see silver outperforming gold.
Now, why is that? Why is that generally the case?
Well, generally, silver is always kind of considered gold on steroids. It's much more volatile, but it's also a smaller market. So when people start piling in, it can get pushed around even easier. Right. And when you're in a bull market in commodities and in precious metals in particular, you expect gold to do well, but you expect silver to do even better, and you expect the mining stocks to do even better than that.
You know, it's interesting, Brent, because both of us were speaking at the San Francisco Silver and Gold Summit. And one of the things that I heard there all the time was that because we were at this 80 level on this ratio, that was a blaring sign that silver was the better buy. And that it was silver that had the more upside. It's interesting that you're taking a bit of a different angle on it.
Well, and it is, and that's kind of why I chose this, is because, like I said, this level that we're at now, this between 75 and 80, has kind of been used as by many people to say, these are historic extremes. This is where you got to buy, and it is, unless you break through there. But the problem is if you break through there, there's nothing stopping it from going to the all-time high, and we've done that now.
Well, let me interrupt you there. Let me ask you this way, because this is what I think is interesting. First of all, this breakout in gold. We just had Marin Katusa on Macro Voices, and his view was that the gold bull market is not starting yet, and that gold is very likely even potentially going to retest its lows from 2018, and obviously, in my mind, in order for the gold silver ratio to reverse and go the other way, I would imagine that we would have to be in a pretty good bull market in gold where silver is suddenly getting a lot of attention. What's your thinking on the gold bull market narrative?
To be honest, I tend to agree with Marin here. I've been a big advocate for gold for a long time. I've been owning physical gold for clients for over 10 years. I've been putting out videos and speaking at conferences and doing podcasts and things like this for the last 6 or 7, talking about the benefits of owning gold in a portfolio, in physical gold, and how important it is. That said, I've also been saying for the last couple of years, I don't think it's time for it to actually really break out, and I don't think the quote-unquote gold insurance policy is going to pay off yet. And I kind of still feel like that's the case. So I am not convinced that we've seen the lows and that we're now taking off to a bull market. And this chart is why I'm showing it to you.
Yeah.
So this is one of the reasons.
Why did you choose this chart on the PBOC? I want to just go back here.
Yeah.
Like what's your thinking on China here?
So this is a very important chart, and I hadn't really thought of it in this respect until I read a piece by Russell Napier earlier this week. And I don't know if you guys don't follow Russell Napier, you should. He's a fantastic strategist.
Well, it's funny you say that because we're actually recording him on Tuesday for Macro Voices. So.
Oh, that's fantastic. Awesome. I mean, he's one of my favorite writers.
Yeah.
Even when I don't agree with him, I always like reading his stuff because he's as smart as they come. He knows his history as well as anybody, and he always makes you kind of think.
Yeah.
And so the recent piece, he was talking about how he was going around the world and what was on everybody's mind was the quantitative tightening by the Fed, and Russell would come back and say, well, what about the quantitative tightening by China? And everybody would laugh and say, what are you talking about? China's not tightening. But they actually are, and you can see here that their balance sheet over the last, if you look at the very top up there, you can see it's lower now than it was earlier in 2018. Right. And the reason is because that red line is their foreign exchange assets. And their foreign exchange assets are falling, which is reducing their balance sheet, just like the Fed's reducing their balance sheet. But the reason their foreign currency assets are falling is because they are having to spend an incredible amount of money to defend the peg. And that is creating, so as the U.S. tightens, they have to tighten in order to maintain the peg. And the thing is, China can't afford to be tightening right now. So I think this is as important a chart as any in the world.
You think that the renminbi is going lower then?
Yes. Yes.
So
I think if they do not, if they insist on defending the peg, then their balance sheet is going to have to continue to fall, and I don't think that they can afford to have their balance sheet continue to fall.
That's an interesting view. Like the last time, I think their foreign holdings at one point was somewhere around $4 trillion in the reserve of it, and that's just been shrinking for several years now. So I mean,
go back to 2015, and you can see it was around $4 trillion. Today, it's about 3.1, I think.
Exactly, about 3.1. So they've seen about a 20 to 25% drop in that holding. But I mean, I remember hearing something that they really can't let it drop below too much more than like 2.8 or something like that, because at that point they need a certain amount of the U.S. dollars to conduct global trade. I mean, I guess
Exactly.
we're getting into.
They are in a tough spot. I mean, China is in a very, very tough spot.
Yeah, and that's why I guess the whole de-dollarization thing is such a hot topic, right?
Right, exactly. And this is part of the reason I'm such a dollar bull.
Right.
So, Brent, one of the things that I've always watched is the gold priced in renminbi. I was wondering whether you had any feelings about like how this balance sheet reduction would affect that, and what you think that the implications for the gold price might be for that.
Well, to be honest, I don't follow gold in renminbi that closely. I know a lot of people earlier this year were saying that the price of the yuan and the price of gold were linked, and China was in control of the price of gold. And to be honest, I think that's craziness. I don't think China's in control of anything, let alone the gold price.
Oh, so you think they're just struggling to survive and just trying to like patch the holes in the boat as best they can?
That's my opinion. Yes. Yes.
Okay, and that's what makes a market. So I looked at their level, and I thought that 8,200 level, they were defending it. And I kind of looked at it not so much that they were pegging it, but that when gold went below that level or around that level, they were there buying it and supporting it and creating liquidity, basically monetizing against it. But that was my opinion. We've subsequently jumped way higher, and we've gone from 8,200 up to 8,800 on like gold price in renminbi. But what do you think about gold priced in dollars?
Okay, so I'm like earlier about a month ago, people were asking me if I thought gold was headed higher, and I said I didn't think it was. I thought it might, but I didn't think it was. But I was wrong, and it has jumped higher. It's ran up to, I think it touched almost $1,300 last night. And so we're kind of right at this long-term resistance level again, of the descending resistance going all the way back to the high in 2011. And I mean, I think that holds on both kind of a yearly and a monthly basis.
So to be clear, you think we're rejecting here, right?
I think we are rejecting here. If we don't reject here, I think it's possible that we could, over the next 2 to 3 weeks, maybe even a month, jump up into the 1320 to 1330 range.
Well,
but I don't expect this to be the breakout.
It's amazing that you're pointing out the same level, because we're going to be talking about gold later on things to watch. But I was even mentioning a macro voices there. I've followed like 3-4 different strategists that all come up with the 1290 to 1300 level, but all for completely different reasons. And now you're the fifth person that gives that level with a different trend line. So to me, this kind of 1290, 1295 level is where there's a Fibonacci retracement level, which is important.
Exactly. And which we literally just hit that and rejected today.
Exactly.
And listen, I'm not saying that gold can't go higher. It absolutely can go higher. My guess is that over the next, call it month to 2 months, gold will bounce around between 1280 and maybe 1320, or 1275 and 1300.
You think we're going all the way back to retest the lows, though?
Eventually, yes, I do. Yes, I think if gold does not take out this 1350 level by the end of March, I think it has to take it out in the first quarter, or else we're going back to the lows.
So let me jump in here, Patrick. It's Kevin, and you guys are talking about the Fibonacci squiggles and stuff, and to me, that's my eyes are glazing over. And but one of the things that I've been watching is the 2-year tip yield, and I think it's actually one of the most important charts out there. It's in essence represents the real yield in terms of the yield after inflation that an investor can get, and this hawkish Powell, and I just was going to ask Brent his opinion about whether he really is as hawkish as the market thinks he might be. But this hawkish Powell has taken this from October 3rd, the 2-year tip yield, from 1% to 1.8%, a rise of 80 basis points. To me, that's really difficult for gold to rally with real yields going up that much. So I have 2 questions for you, Brent. What do you think about the fact that real yields in the States are going higher, significantly higher? And then B, what do you think Powell is trying to accomplish? And what would you give him his grade so far in terms of how well he's done?
Okay, so I think as real yields rise, that's in general, that's not good for gold, right? So I would say as real, when yields were negative, what was it 1 or 2 years ago, 2016? That's when gold really went crazy, right?
Right.
But as real yields rise, that should not necessarily put a cap on gold, but should keep it from completely breaking out. Unless gold can also pay off under a deflationary scenario if the safe haven trade gets big enough, right? But
right,
I'm just saying that as long as markets continue to function, real yields rising is not great for gold. Yeah. As we go toward, as I go to the answer to your question about Powell, you should know that it's very hard for me to say anything positive about any central banker in the world. So please keep that in mind as I say this. I think that Powell has done a masterful job for the job in which he was put in to do. Now, that doesn't mean I think everything he's doing is right. It doesn't mean I like him. It doesn't mean all this other stuff. It just means that if I'm sitting in his shoes and I've got to do what he does, he's doing a pretty damn good job of it. I mean, the guy raised 4 times, and the dollar is about the same place it was when he started. Now, to me, that's a pretty good move, right? I mean, he doesn't really want the dollar to go through the roof because, a strong dollar isn't necessarily great for the U.S. either. But, he's done it, and the dollar has risen but not gone crazy, right? And he's raised the rates 4 times, and the 10-year yield is right where it was when he started, or it's a little bit higher. So, and he's raised 4 times, and the stock market is 5% below where he started. So, and all these people, I got to tell you, this whole central bank Powell raising rates and the volatility we've seen in the equity market over the last 2 months, it really kind of drives me crazy, to be honest, because all the people that were complaining that the central banks were keeping rates down and were blowing these bubbles are the same people who are now crying because he's raising rates and freaking bubbles.
Right, and not only that, it's the backup in the stock market is pretty minor when you step back and look at a big picture.
Exactly. Now, don't get me wrong. I mean, Jesus, we've pulled back 15% in 2 or 3 months. I mean, that's nothing to ignore. I'm not saying ignore it, but when you step back and look at where we were in 2011, 12, or 13, and you see where we're at now, I mean, I guess this is my point: is the hypocrisy that I hear from people when they say it's normal to have corrections, but then when you actually have one, they freak out and they say the Fed's making a mistake. Like,
okay.
What do you want him to do? Do you want him to raise rates slowly and try to deflate this bubble, or do you want him to keep it low and blow it bigger? I'm just saying, a lot of the people who were saying the Fed is creating a crisis by blowing bubbles are the same people who are saying the Fed's creating a crisis by pricking the bubble.
Yeah, no, I agree with you there. I have a question for you. Do you think that he's more scared about inflation or a financial markets bubble? So when he's gone out ahead, there's no doubt that he got hawkish after October 3rd and said, we're a long way from neutral. Was he truly worried about inflation, or was he more worried about the stock market and credit markets taking off and making it ultimately, when this bubble does collapse, all the worse off? So is he more worried about inflation or market bubbles?
That is a very, very tough question. I think that he maybe I think that he has come to a point where he believes that he can no longer just choose Wall Street over Main Street. A lot of people will say there hasn't been this crazy consumer price inflation. I mean, by the CPI terms, that's true. But if you go to Cleveland or Detroit or Nashville or Dallas and some of these places in the Midwest, I mean, their cost of living has gone up, right? And I don't know that, and a lot of these people live on their savings accounts, or they have CDs, or they don't have brokerage accounts. They don't have these big stock portfolios that maybe the people on the coast of the bigger cities do. And I think he realized. And then if you think about the pensions, right? The pensions are in crisis because there's no yield. I think he realizes that they have to get rates higher. Now, if he's really pushed to the wall, will he relent and go the other way? Probably. But while he can, I think he's kind of making hay while the sun shines, so to speak.
Okay, and then here's a question for you. We're recording this Friday night after the market closed. He spoke earlier with Yellen and Bernanke, two Uber doves, and he issued a lot of cooing words himself, and that sent the market higher. Did he just reestablish the Fed put? What do you think?
No. I think people hear what they want to hear, to be honest. But again, this is him I think he's doing a masterful job, right? I think he had to come out and say something. If he's on the stage with the two biggest doves in history, and he sits there and he says, we are hawkish because that's the right thing to do, he's basically giving the middle finger to those other two sitting next to him, right? And if he wanted to give the middle finger to the two sitting next to him, he wouldn't even have gone on the stage with them to begin with.
Right.
So I think this was an opportunity for him to come out there, say what he needed to say to calm the markets a little bit, but nothing has really changed. He didn't say, I'm going to reverse course. He didn't capitulate. He said the same thing he said a year ago, which is as data dependent, and as if we need to do, we'll do what we need to do.
Okay,
now,
so sorry, go ahead.
No, I'm just saying, so you can interpret that as dovish, and I think the market did, and I think he wanted the market to interpret it as dovish. But what happened when he did that? The markets went up, and the 10-year went up, I think, more than he probably wanted it to. But the 10-year went up, the stock market rallied, and the dollar came down, which makes it even easier for him to raise rates again.
Right. No, you're absolutely right. So final question for you. The next move from the Fed, up or down?
Up, no question.
Yeah, okay.
Well, I'll take the other side of that.
Okay.
All right, Brent, I'm going to follow up with you on that one. This is a bet that we've got on
I think
now.
I think that'll be a pretty popular one. I think a lot of people will take that bet with me.
Well, we'll discuss it over a beer when we're out in Vancouver. Anyway, let's move on.
Okay, so Brent, we're going to put you on the spot here. A man of your legendary status, I'm sure, has heard a couple of good tales or been involved with a couple of good tales on Wall Street. So we were wondering if you could share one with our listeners.
Sure. I don't know if I'm ready to take a title of legend, but it's you're proving the point that Canadians are actually nice, so that's good. No, so this isn't really a trading story, but it is a Wall Street story. I'm going to go all the way back to the either first or second month that I was on Wall Street. I was in my Wall Street training program. I was with a firm called Donaldson, Lufkin and Jenrette.
Oh, and DLJ.
DLJ. We were in New York, and as part of our training program, part of it, we'd go talk to the private equity guys, and we'd go talk to the sales and trading guys, and then we'd go meet with the investment bankers, to try to get this big overview of quote unquote Wall Street and how it worked and all that. And as part of that, they set us up to have a tour of the Federal Reserve Bank of New York. Now, at the time, I wasn't as into gold as I am now, and didn't really think too much about monetary policy like the way I did now. I was just happy to have a job, to be honest. And to be honest, whatever they told me, I believed at the time. It took me a while to wise up that what the masters of the universe on Wall Street say isn't always true. But anyway, as part of the training program, they set us up to go down and see the Federal Reserve Bank of New York. So, we all get in our Blacktown cars and we drive down there, and we think we're pretty hot stuff. And one of my buddies, or I shouldn't say what buddy, but one of the guys in my training program, he thought he was a little bit better than everybody else as well, which is, again, pretty normal for a Wall Street training program. And so, we're all dressed up in our suits and our ties, and we go walking into the Fed. And, I will say, I'll say this, the Fed did a very good job of hiring a very nice-looking female intern to give us our tour. And let me just leave it at that. And as we were walking around, more than one of the gentlemen in my training program was angling to stand next to her or talk to her or make some funny comment to her. And of course, she was handling it like a total pro, and just kind of rebuffed everybody nice and easy, and kind of laughed a little bit. She gave us a tour of kind of the whole building, and told us about this is where they meet here, and this is where they work on this. And then at the very end, I think the tour was like, let's say an hour, 2 hours, and she's been putting up with these
jackasses,
jackasses, for 2 hours at this point, right?
Fair
and
enough.
At the end of the tour, they take you down to the vault. What is it? 8 stories below where the gold is.
Come on. You got to go see the gold?
Swear to God.
Okay, whoa. We got to stop here because there's lots of people who claim the gold isn't there. You know, the tinfoil
that's
hat
Fort
guys.
Knox. Everyone knows the gold's at the New York Fed. It's Fort Knox where the gold is not.
Okay, sorry, I got it mixed up. Sorry, Brent, continue.
Yeah. No. So it's good. So yeah, I mean, you pile into these elevators and you go down, and the doors open, and you walk into like this little. I mean, and this is how it's been 20 years ago since I did this, so I might not have it exactly right. But there's like a little, anteroom that you kind of exit the elevators in, and you're standing there, and you basically walk into a room that looks like a big jail, for lack of a better word, because it's a big room, but there's all these cells, with bars, that are separating one cell from another cell, but you can see through the bars, and behind the bars are these pallets of gold bricks.
Really?
And yeah, I mean, it's really interesting. It's really cool. And one of the cells would say like Italy on it, and another one would say Brazil, and another one would say whatever it was, Ghana or whoever. I don't remember whose gold it was, but they had, and I'm sure part of it, this isn't the main holding, right? I'm sure this was a little bit of a showroom or whatever, and then you have to go through more doors to get to the big hoard of gold. Right. So I don't know that we were in the holy of holies, so to speak, but we were so we're down there, and of course, she's explaining to us why central banks own gold and why they store it with the United States Fed, because they're so trustworthy and in times of crisis, all this stuff, right? And of course, all the guys have to pipe up and have these clever comments. And again, she's just rebuffing them. She is the most diplomatic person I've ever met in my life. And finally, she said something about, she was talking specifically about the bars of gold and how pure they were or whatever. And so one of these guys says, "So why does that bar say fool's gold on it?" And she looks at him without a beat and says, "That's your bar." And then when she said that, I about fell over laughing, and I swear to God, that's still one of my best memories from living in New York.
Oh, that's
on Wall Street.
That's terrific. If that woman is listening, she should dial in and chat with us.
She should be running the Fed. Honestly, I mean, that girl is as smart as anybody I've ever met. And if she's not running the Fed someday, that they're doing themselves a disservice.
Oh, that's a great story. Thanks for sharing that with us, Brent.
Well, Brent, that was a great story. I want to move on, though, here. Kevin, what did you think was the most important thing of the week that we want to discuss?
Well, there was definitely a lot of action in the FX market, which is unusual because lately it's been all centered in the equity market.
Couldn't agree more. The dollar index has been pinned for like months, and it just hasn't reacted at all during this whole period.
And what was it, 2 days ago when Apple released their bad earnings? What was that? Was that last night or when was it?
No,
two
was
nights ago.
A couple nights ago.
Yeah.
Wednesday. It was Wednesday.
That's right. So Brent's going to join us for this conversation. It was Wednesday night. Apple released their bad earnings after the bell. And I guess there wasn't a lot of markets to trade in terms of the S&P futures had been closed. And there was this terrible earnings, that in terms of Apple, shitting the bed with their iPhone sales in China. And I just want to pull up what happened in the FX market because I think it was actually quite a big deal. And here is the Japanese yen. You can see that kind of going into the close, it was trading at 108, like 80 roughly.
Well, you should correct. I'll correct you there. It's the U.S. dollar.
Okay, sorry. It's the U.S. dollar, versus the yen. Okay. So, and you'll notice that as it goes down, that means the yen's increasing. Right. So that was a monster rally in the yen. And it's kind of shocking how much that, it was just like,
it was crazy.
It's hard to kind of put into proportion. I'm going to go through a couple of charts, and then I'm going to show you a table at the end, and then the three of us are going to chat about it. So this was the yen. It went from 108.88. It ticked down to 104.50. So that was an increase in the value of the yen. The next chart shows the Australian dollar. The Australian dollar went from 70 down to 66, which is like four big figures in kind of like, in space of 5 minutes. It was just crazy. Yeah. And then what I did is I actually created the AUD, like the Australian dollar Japanese cross rate. And you can see that thing went from 76 down to 71. Now,
but what's amazing, though, Kev, was that it was really only these two currencies. I think the only other currency that reacted was the Turkish lira. Yeah. But like the other currencies didn't even budge. It somehow was narrowed into these two pairs.
Right, and it had to do with China specifically, and that was the issue. It was a China trade because of the Apple news. Now, and it's more complicated than that because Japan's a funding currency, and a lot of people have carry trades on that way. And so I'm going to go to the next chart, which is a table I created. And what this is the largest intraday yen moves since 1970. I actually spent a little time and went through them and ranked them all. And it was actually kind of fun because I got to realize in 1973 there was a dollar devaluation that caused a intraday move of 9% in Japanese yen. And you go through them here and you'll see that there's long-term capital management, Brexit, the great financial crisis. You keep going, you'll see that there was the nuclear tsunami disaster, all sorts of stuff like that. And then you get to this point, it's the 28th largest move, which doesn't, maybe that doesn't seem like that much, but considering that it was because Apple's earnings missed, and out of the blue, we moved almost 4%, and it just kind of caught a lot of people off guard.
Well, me included.
Yeah, and I kind of have this theory, and it's called there's no such thing as a bad tick. Meaning that when you get some kind of weird move like that, it means that that's the direction the market wants to head. And that eventually that level will be retested. That there's no way that was the kind of the high in the yen and that we're going to go back there. Because that is the kind of the area of least, or the direction of least resistance. And it's more complicated than that because I think it also corresponded with the fact that Japan wasn't there to intervene the other way, that they were on holidays and stuff. But it just goes to show you that this was a bigger deal than most market participants realized. The 28th biggest move because of an Apple's earnings missed, and I think it's a symptomatic.
But is that known for a fact that it was Apple? Was it coincidence that Apple's earnings was at the time? Is it really Apple?
So what do you think, Brent?
So I don't know, to be honest, and I've kind of been curious about this as well, mainly because I'm not exactly sure, but I'm not even sure Japanese markets were open.
No, they were definitely closed. They were on holidays. There's no doubt about it.
They were on holiday.
Yeah.
And it like you said, it was restricted to those three. Like the dollar and the euro didn't move that much. The pound didn't move, I don't think, that much.
No.
It was kind of restricted to these currencies. And I think the yuan didn't move that much either, right?
Yeah. No, you're right. It was specific to these cards.
So I don't know that it was China related either. So I don't know. Here's the other. I've got a question for you real quick. So I'm not sure if I misunderstood what you said, but are you saying there's no way that the 104 tick was a bad tick and that we are almost guaranteed to go back to it? Or are you saying...
I completely agree with that. I think that it shows that is the kind of the direction that we're headed on this.
Got it. I'll take the other side of that trade.
Yeah, and I think Brent Brent will too. Yeah, I think.
Yeah, there you go, Kev. Both of us just sold to you.
Okay, so there's no such thing as a bad.
Well,
tick.
here, let me tell you kind of why. Because it happened in kind of a wonky time period, even without Apple having those earnings, right? It's the Wednesday between New Year's and the weekend, and it's still somewhat of a holiday time. Not everybody's back at their desks. Japan's closed. It's at an interesting time of day when the liquidity's low anyway, and then you throw in the holiday, and then you throw the Japan's out. But here's the other thing. Here's the other thing. The Japanese currency rose 4% in the 2 weeks prior to that 4%.
Yeah,
so it moved
Brent,
8%.
I got to interrupt here for a second because I can actually see Kevin on the camera right here, and I think I see the Emperor from Star Wars here. He is being empowered by the fact that we're taking the other side of this. He's got a pine in here.
He loves it.
Oh, he loves this. Are you ready to put real money down on this one here, Kev? Now,
well, no.
The fact that we're disagreeing with
we have so many steak dinners going that we don't.
Oh, God, I got so many damn side bets between Twitter and you guys and everything else.
I contend. Well, it's a big test for. There's no such thing as a bad tick, and if I'm wrong, I've lived a life of a lie. Like that, because I truly believe over the years, every time I've seen a situation where there's been a tick out of the blue in an e-liquid situation that's gone a specific way, I've always been surprised that the next kind of move is for that kind of strange move to be justified. And I don't know how, and I don't know. I'm not going to sit here and tell you how it's going to be justified. I don't know. I just know there's no such thing as a bad tick.
Hey, you know what? I actually really love the theory, so I may have to steal it. I'm not ready to bet on the yen getting back down to 104 right now.
Yeah, and maybe it'll be the Australian dollar that kind of saves me, because I'm a big Australian dollar bear, because I actually think China's in a little bit of trouble. And so to me, I think that one was much more understandable, selling Australia when you get kind of bad news out of Apple China, like that made more sense to me than Japan. But I just think there might be more carry trades out there, and there might be more weak shorts than we think in the yen. And that's what I think that the market is telling you, is that the surprises might be that in a risk-off situation, how quickly that kind of yen rallies on us and kind of catches people off guard.
Yeah, hey, anything's possible.
All right. Well, let's move on. Brent, thanks for being our first guest, and I'll catch you out in Vancouver. All right, Kev, let's move on. This week in trading history, what do we have on the plate?
Well, this week, back in 1977, Apple Computer was incorporated. It's hard to believe.
1977.
Yeah.
And
it's hard.
Steve Jobs, he was quite the handsome fellow when he was a young man, wasn't
he? So you like that? You like Steve? You got a man crush. So one of the things
who's the other guy in that picture? Oh my God, I'm embarrassed.
Steve Wozniak. Do you have a man crush on him as well?
No, that beard is.
Even by hipster standards, it's a little kind of unruly. So, we don't have a lot to talk about with Apple. One of the things I do want to mention is that there, a lot of people know the story of how Steve Jobs was run out of his company, and then that fellow came in and ran the company into the ground, and then Steve Jobs came back. But a lot of people have forgotten how precarious the situation was when Steve Jobs came back. And one of the things that I just kind of want to talk about is the Apple Store. The Apple Store has been one of the greatest retail achievements ever. Everyone takes it for granted today that you go into an Apple Store and it's packed and that there's all these great things. But I remember back when Steve Jobs decided he was going to make these stores. And back then, there was Gateway Computers had tried a store. I think someone else had tried a store, and it had failed miserably. And Apple Computer, under Steve Jobs' new leadership, had decided they were going to make 10 stores. And I remember reading all the Wall Street research about how this was a waste of time, how Steve Jobs should just focus on his products, and that this was the most ridiculous thing ever. And I have never forgotten that all the time. Like, I'm going to take that to my deathbed. The fact that everyone was so uniformly bearish on Steve Jobs' retail store idea. And I remember when I was visiting, I was in Boston. And I went out and we were staying in the Back Bay, and we went out to Brookline because that's where there was a store. And I dragged my whole family out. We had small kids. I said, I got to go see this store because it was one of the 10 or 8 or something. It was one of the first ones. And it was fascinating because I was like, I got there and it's like, where are the products? Like, what the hell's going on here? Because it was just like these tables, and it was the strangest thing in the world. But it was amazing to me at how different it was and how much Wall Street, or how long Wall Street took to understand how successful it would ultimately be.
There were so many little things that Steve did that revolutionized the whole process. But, the one question, though, is that through the evolution of innovation, and there was, like, for instance, originally the Palm Pilot and BlackBerry, and then Apple came along and really stole the smartphone market. There's some company out there that is going to make Apple the next Palm Pilot.
Well, it could be, and I'll tell you one thing that I think is very difficult for most people. Like, everyone's giving Tim Cook a hard time. And they're saying he's no Steve Jobs. Of course he's no Steve Jobs. It is so difficult to sit there and to go and say, I know better than all the analysts. I know better than the market. I know better than everyone else. Because it's like the Henry Ford. Like, Henry Ford said something to the effect that if I asked customers what they want, they would tell me a faster horse. And Steve Jobs was like a Henry Ford that way, and he knew, and he could actually say, like, these are what people want before they knew that. But the thing about it is, it takes tremendous courage to go do that. And so the reality is that Apple doesn't have that courage anymore. Apple is just
I think it's just too big.
Yeah.
Like, you know, when you hit $1 trillion market cap, I mean, you think about the type of earnings growth you have to have in order to appease the markets. You can't take bold risks with that kind of. It's almost like a new Coke risk, right? It's such a huge company that they have to really at this point monetize what they've built. It's more instead of innovating, they're more managing what they've created at this stage. No,
I completely agree, but that means that the days of massive growth and for them to own a market like they did with the iPhone are probably behind them.
All right, listen, I want to jump into the chart of Apple because I think I want to change the topic just a little bit. We just saw during this bear market plunge as the FANG stocks got decimated, Apple drops from like its $235 price range all the way down to $140, right? Like this on a technical basis here, that was a 40% plunge basically in a span of 3 months.
Yeah, that's a shit the bed kind of chart
pattern. That's
pattern.
crazy. But I want to go back and look at the last time Apple did this. We got to go back to 2012 going into 2013. And it was back here that Apple, there was no bear market, right? There was no bear market. Apple goes basically from $100 a share down to like 55 and wipes out 45% on the downside. And the question I have, is this going to be a buy on dip on Apple? What do you think?
No.
No.
I think that Apple's good days are behind it, and that I'll tell you something.
Yeah, but if it gets cheap enough, I mean, anything. Like, if you take the stock low enough, then there's always room to rally.
Yeah.
How low does Apple have to go for you to be happy?
I don't know. I'm not sure. I look at the bigger picture, and I think that it's increasingly difficult for them to continue to dominate like they have. I look at them on the computer side, and I've been disappointed in them for a long time. Way back when in early 2010s, I actually switched our whole family from PCs to Apple. And my wife used to phone me up and say, I can't get the computer to do this. And I would have to walk her through it all. And then one day I said, I'm going to try buying her an Apple. And it was right around the stage of, with those kind of Justin Long commercials. I'm a PC, I'm an Apple. And the whole thing about it just works. And I bought her an Apple, and I never heard from her again. Well, at least when it comes to computers, I never heard from her again because it just worked. And to me, once Steve Jobs went and took over and put Intel chips into their actual computers, I said to myself, this is a free call for me. I can put Windows on this Apple, and if I like the Windows, if I like Apple, I can keep the Apple operating system, and if I don't like Apple operating system, I can put Windows on it. So from then on, I just bought Apple computers, and inevitably what happened was I stopped using the Windows and I started using the Apple. Well, they have gone and just kind of disappointed me time and time again. They're more focused on phones. They're not really.
You're going to get hate mail. You realize this, right?
Listen,
there's going to be hate mail coming in.
That could
to our listeners that are typing the email. Just think twice before you send it.
They're
to Kevin.
typing it on a $4,000 overpriced Apple MacBook. Is what they're doing it. And listen, I was the first guy to one of my buddies always say, "Why would you pay for Apple?" And I said, "It just works. Like it's worth it. It was worth it for me to pay the premium because it just worked." Well, I actually find Windows 10 to be pretty darn good. And not only that, for the first time, Microsoft's offering some real products to compete with it. And I'm frustrated. Like, you go ask Adobe what they think about Apple products. You go and ask for the longest time, there was all these pro kind of guys that would use Adobe products on Apple's. Well, I'll tell you something. They've all moved to PCs because they don't make a Mac Pro anymore.
So let me get this straight. You put Apple more in the Facebook category at this moment. Is this we've seen the peaks and that these things have rolled over. This is one of those FANG stocks that are going to spend a while mean reverting.
Yeah, well, maybe it bounces. I don't know. You can tell me.
Well, okay, a bounce is a bounce. Listen,
but
anything that's this oversold is going to give us a reaction.
Right.
Like I'm not talking it. Look. Technically, this stock could be at 170, and your story doesn't change one bit.
So I could completely see a rally up to 175, 180, whatever the squiggle tells you. I'll tell you one thing: the fact that Warren Buffett, the octogenarian, did I say that right? Anyways, he's decided that he was going to finally go into tech stocks, and he bought Apple. And to me, it's no surprise. It's just like him wandering into the silver market. Like he's made a mistake, and I get it that he's big and he can only buy certain stocks. He has to buy big stocks, and it's cheap. But I think it's cheap because it's fully saturated, and I think it's going to be tough for them to grow. And I'm a seller. Like that's on rallies, you sell this thing.
Wow. Okay. Well, you heard it from Kevin Muir.
Yeah.
All right. Let's move on. Kevin, time for the WTF clip of the week. What did you put together for us?
Well, it's kind of shocking that we've gone 9 episodes without making fun of Cramer yet. So I kind of thought it was time, and he was giving us a little history lesson on buying the stocks in a bear market. So I thought we would kind of do a mashup of his other history lessons that he's given us. So we start off with his most recent comment about buying stocks into the dip. And then we kind of put in a little bit of his 2008 special kind of, let's call them outbursts or moments. That's a nicer way, a more diplomatic thing.
His moments.
So let's listen to it.
Here's the bottom line. When you approach the stock market with a truly long-term time horizon, you have to remember that big bear market declines can actually turn out to be excellent buying opportunities, as we've seen since we started the show, as long as you only purchase high-quality merchandise in small increments on the way down.
Cramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. And Bill Poole has no idea what it's like out there. Bear Stearns is fine. Do not take your money out. This is real. People have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business. And he's nuts. They're nuts. They know nothing. Look, if there's one takeaway other than a plus 400 somebody, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Cramer.
I have not seen it like this since I went 5 bid for 500,000 shares of Citigroup when I got hit in 1990. This is a different kind of market, and the Fed is asleep.
Okay,
the Fed is asleep, eh?
There's so many things in here that we have to go through. We have to dissect because, it's just unbelievable. There's so many gems.
Well, first of all, this is the first WTF clip that we ever did where we didn't have to bring in footage from a third party to actually make it funny.
That's right. He kind of does his own entertainment. So let's just start with the beginning. He talks about buying into the dip for long term, and then tells us how it as seen by today's rally. So he's kind of mixing time frames already. He's saying, "Look, you're already up." So like he's kind of mixing. So it's just the absurdity of saying, "Oh, you should buy for the long run," and then saying, "As you saw by today's rally," is just ridiculous. But the kind of the point that just makes me laugh is that last little bit where he says when he's just going, kind of like he's I don't know how to describe it. He's very animated about the fact that this was just like when he bid $5 for 500,000 shares of Citibank. Okay, so I don't know. I'm not very good at math, but is that $2.5 million?
Yeah, he's a high roller.
Yeah, I know. I'm like, so let me get this right, Cramer. You bid $5 for 500,000 shares of Citibank, and you got hit, and this was the end of the world. Like I just don't understand. Like, even like I'm a Canadian and we don't trade as big as the Americans do on Wall Street. And even in my day, I haven't been on an institutional desk from, since 2000. But even to me, 500,000 shares of a $5 stock was kind of an odd lot. Like, I don't really get what he's screaming about. So I just don't get him. Like, this was supposed to be the end of the world. He got hit with his 500,000 shares of Citibank at $5.
Listen, I mean, he's an animated fellow. I mean, that's why he has a huge following, right?
Yeah.
I mean, only if we can ever be as animated as Cramer, right? This show would be like taking off. But the one thing about him is that he's got that attitude that there's always a bull market and everything. But you know what? I look at things from a far more of a Jesse Livermore approach, which is it's not about being bullish. It's not about being bearish. It's about being right.
Yeah.
You agree with that?
Yeah.
Look,
I kind of think there's always a bull market in everything. There's a bull market in his bullshit. Like what's this thing? Like he's telling you not to take money out of Bear Stearns. Why is he giving people advice of that? And it ended up being absolutely terrible advice. Literally, I think he did that Friday afternoon, and on Sunday they closed the shop.
Yeah.
Like like maybe it was.
That's one that he's gonna have a hard time living down. Really, to be honest.
Yeah, I know. Well,
I mean, think about it. It's a decade later, and we're bringing it up, right?
Yeah. Well. And maybe we'll be so lucky that people will be bringing up our bad calls a decade later.
I would be proud. All right, let's move on.
Okay, it's time for the top 5 things to watch next week, and we have to go over last week's top 3. But Patrick, I see you're kind of running ahead of me and opening your second beer. You must really like this week's sponsor.
This is actually a really good beer. The All or Nothing Brew House. It's actually a great beer. It's a 1-2 punch of flavor.
I'm so proud of you because last week after that debacle of you insulting our sponsor and I got a terrible call from the representative saying that they would never sponsor us again. So we're gonna have to,
Oh, thank God! Actually.
Okay, so let's have a look at the top 5 things to watch. And before we do that, let's go over last week's. And now last week was the Christmas or New Year's kind of week, and we were lazy. We only did 3.
We only did 3. But number 3 was actually the Squiggles prevailed, didn't they, Kevin?
Jesus! Like I'm gonna have to hear about this forever. So
let me just pull up the chart just to explain. What was the level I mentioned? By the way?
Wait. Let's tell people. What was
the level? What was the level?
It was 73, but you didn't even talk about it in the right way. It should be 1.36 or 365.
Oh my God! No. Listen, I always put the currency as the base and the U.S. dollar as the cross. I'm sorry. That's the way we look at it. Look how confusing it was when we were talking about the yen. Look, this is the Canadian dollar. The Canadian dollar was at 73 cents, and the Canadian dollar went to 75 cents.
You know what? I hear you. That makes sense. Like I actually agree with you. And
I think it's stupid the way the forex market do it.
It's true. It's too long on institutional desk for me is my problem, and that's how they do.
But 73 held.
Yeah,
the Squiggles prevailed.
So we're talking about the Canadian dollar, and I've been somewhat bullish and early and wrong. And Patrick went and
I took the other side of the trade.
You took the other side of the trade, and not only did you take the other side of the trade, you then went and said, I'm covering here and going long. So, maybe I should work harder on the Squiggles. Like, you know.
Well, so, even a broken clock is right twice a day, right?
Yeah,
Ken?
well, that's not true.
So,
The
you know what?
squiggles-
Let's see the squiggles prevail more than once, and then you could start drinking my Kool-Aid, right?
Okay. Well, anyways,
All right.
the short-term low on the Canadian dollar held, and it was a short-term low, and
Yeah,
looked like
so
we're
number
rocketing
2.
higher.
We were saying what will end up being the top performing asset ended up being cash. But Treasury bonds made a huge run at the end to try a push.
Yeah, they tried, but there's no doubt it was the first time in 19 years that
It was only like 1% away. Like,
Yeah.
I mean, Treasury bonds were positive, and I think by actually the first couple of days of the year, I would argue if you attacked on 2 extra days, they might have actually made it.
For those that don't know, and it's not that it's obvious or anything, Patrick is a little bit of a treasury bond bull.
Just a little bit.
A little bit. And not only that, he just, every single time it upticks, he like sends me a tweet or sends me kind of a text saying, look at this, look at this, look at this. And it's getting kind of annoying. So I'm hoping that this treasury bond rally is over so I don't have to listen to him anymore. Okay,
Well, you know what? The squiggles are saying you're going to be right soon, so don't worry.
There we go. So the number one thing we were watching this week was the U.S. economic data. And
But it was really global data, wasn't it? We should have really included a few of these other global PMIs, no?
Well, you're absolutely right there. That China was terrible. It was awful, and it caused a huge sell-off in China in terms of risk-off. Then we had a terrible PMI in the U.S. yesterday with I guess it was the lead orders that was really especially bad. Like the manufacturing in general was bad, but the lead orders one was bad. And at that time, what was interesting was that the Fed funds futures market was pricing in, not only had they taken out all the hikes for 2019, they were pricing in a cut. It was shocking. It was absolutely nuts how quickly we've gone from that. Then this morning, we get the unemployment number. Now, I would argue the unemployment number is a backward-looking indicator, but it blew the doors off. It was like unbelievably strong, and the Fed funds futures market quickly gave back everything and was now back to pricing in a hike. So it's been tons of action in the fixed income market. Like it's been crazy.
It's schizophrenia.
Yeah, no, it really is.
It's nuts what is happening. And, Powell says one thing. Powell says the next thing. Every little word, the market swings 2-3%, one direction or the other. It's almost insanity to try to call this on a day-in, day-out basis based on expectations from the Fed. I always tell my members to step back. It's a bear market. You have to kind of just accept the fact that there's going to be these vicious rallies that are going to counter trend in these. And this is just, I think, par for the course.
Okay, so let's go on to the top 5 things to watch next week.
So what is number 5?
Okay, number 5, Patrick and I are having a little discussion trying to figure out how we say this. It's either Sinopec or Sinopec. Patrick has informed me that we're Canadian. We're going to say Sinopec. So it is Sinopec. So we're going with this. Chinese oil company Sinopec has detected unusual financial data in the hedging business of its trading subsidiary Unipec. It said on Friday, okay? And it's basically they've lost a huge amount of money speculating or hedging on oil. Okay. Chinese media have reported that the company entered a collar hedging transaction with the expectation that prices would rise through the end of last year. And let me just ask you this.
Ouch.
Who do you think they did that collar with?
I don't know.
Come on.
Who is it?
So what company were you writing naked puts on, bud?
Goldman.
So
they did it with Goldman?
They did it with Goldman. So it's like these guys that the Goldman can't catch a break with the problems that they had with what was the country that they were having all sorts of, they're getting
Malaysia.
Malaysia, they're getting sued. So there's probably just another country that they've managed to piss off now. The one thing I will say is that maybe I see that they actually fired a couple of traders actually at Sinopec, and I am wondering if more of the oil debacle might be explained by the debacle of the last month might be explained by this Chinese company over trading or getting caught long.
So do you think this is like a nat gas thing, that this was an unwind of this trade and that oil may actually pause here because of that? I
think you should definitely be on the lookout for that and take that as a very real possibility. And maybe by the time the news is out, it's time to go the other way and buy oil. So that's what I'm looking there.
Well, you know what? In the spirit, I'm going to go to number 4, and in the spirit of Brent being on the show, I have to say that this 1290, 1300 level, it's a squiggle level. We talked all these terms like Fibonacci's and trend lines and all these things that were making you get like weird sweats. But to me, this is a gold breakout or fake out level. And either gold, in my mind, is going to break this 1300 level and just rip to 1370 highs, and it's just going to go back up to the 2018 high, or we literally reject right here, especially now that Powell made that. The gold market kind of reacted after that Powell, what was it, a speech or?
Well, he was speaking with the Yellen and Bernanke, and
all right,
so he definitely made comments. Let's put it that way.
He made comments at that.
It was a panel. It was a panel.
He was speaking with the panel.
Yeah.
And after that comment, gold broke. And so if gold was going to fail, it's going to fail right now. It's going to fail at this level, and we're going to go back. Will gold this week break out or fake out? I'm watching.
Okay, so let me get this straight. If it goes higher, you like it, and if it goes lower, you hate it.
That's the squiggle rules, isn't it?
Yeah. Okay, on to number 3. Will European equities finally rally? Now, I've somehow, when we were making this top 5, you've somehow given me this one.
Well, okay,
because I've been bullish and wrong on European equities for the longest time.
Well, the squiggles are going to rule here because we just finished a Canadian-style measured move to the downside on the Euro Stock 50. But what was particularly interesting and what I thought I wanted to mention was the rally that occurred in the last week in the Euro Stock was borderline pathetic, except till today. Today we saw what I think is the first legitimate bull candle or legitimate strength in the European markets. And I just thought it was a worthy question to ask, will the European markets finally catch the bid?
You know what? I feel like I have no credibility to answer anymore. As a guy that's liked it and expected them to do stuff. To me, it's a no-brainer. Germany should be spending. They can borrow money at 10 years at 0.1%. They should be running the biggest fiscal deficit and fixing the imbalances there. But I get all sorts of flack for that kind of talk. What I do find interesting is that everyone that is expecting China to stimulate into this kind of slowdown. It's so misplaced. China is not the one that needs to be stimulating. It's Germany that needs to be stimulating. Germany is the one with interest rates at basically zero. Germany is the one that's actually balancing their budget. And if we're going to look around the world for who has room to actually stimulate, it's Germany. And until we
I don't think they will.
Well,
I don't think they will.
It could very well be, and maybe
I come from a European descent.
Yeah.
And Europeans are cheap. And you know what?
You just probably pissed off our 4 European listeners. So I do apologize. We love all of our European listeners.
Hey, I'm European at heart. You know what I mean? It's this. So no insult being meant to be given there. What I'm saying is, if anyone is holding their breath that Germany is about to flush the system with liquidity, I think you can keep holding your breath, turn blue in the face.
That very well could be. And I think, though, that when everyone sits around, if we do have a situation where we have a sell-off again and people are looking to China, saying China has to stimulate, China has to do something.
And they won't.
That's wrong. China, first of all, I'm a big believer China's not doing anything till 2020. That is when they're doing it. They have a big. I don't know what it is, the 100th.
What benefit is there to China to act? Anyway, we're off topic here.
Okay,
so this is something for a new show.
That's right.
I think because China is a really interesting conversation, and probably in the month of January at some point we're going to bring it up. Anyway, what do you think though? Over under? Okay. Listen, I believe that generally the lows are in for the first leg of the bear market. I've been making the call that for January and even a chunk of February, the markets are likely to, on balance, move higher versus lower. We're going to mean revert that massive sell-off. And I think European equities are going to go higher with that. I think that was a breakout candle. I personally, you can call me out on it, but I think on the short term, European equities are going higher.
I can't disagree. And I think that today, Brent believes that Powell didn't change his opinion. I think that at the very least, he might
We're
not
going to get to this here.
Sorry.
Save that.
Sorry, I'll save
that.
it. Sorry, I forgot.
Save it.
all of our planning down the tubes. Okay, number two. You go
Number
ahead.
2. I wanted to just mention copper. I talked about it on Macro Voices. You're the one who first brought it up, though. I'm going to give you kudos for this, Kev. Yeah, you texted me copper before I looked at the chart, but I would have agreed with you 100% if I looked at it before you. I'll just put up the chart here. Copper had a big breakdown move earlier. Today was a big reversal higher. We came to a pretty important technical level, those double bottoms, major support lines. So hopefully for your sake, it doesn't triple bottom, right? Because what?
No such thing as a triple bottom.
No. So God forbid that copper reverses here and heads right back down to those lows, right?
Because if it does that, it's going to go through.
It's going to go through.
Right.
So copper reversed here, obviously, because everyone went risk on here. But this is important because, they call copper Dr. Copper for a reason, right, Kev?
Yeah, it's the PhD. It's the only metal with a PhD in economics is what the joke, or I don't know if it's a joke or if it's a...
If copper's heading to 1250 or lower, the global economic recession is on. That's my call.
Yeah. Well, and let's go on to number 1.
Number 1. What are we watching here,
So
Kev?
Today was a really important day, and we saw a turn in a lot of things: junk bonds, emerging market bonds, emerging market equities,
so
even European equities.
Local currency. So here's the local currency bond ETF for emerging markets.
Oh, listen, you know me, I'm the most terrible squiggle drawer around, and even I can tell that's a nice clean breakout.
It's been in a consolidation. And it broke out today.
Is that a cup and handle too?
You know what? Yeah, okay, sure. We can call it cup and handle. To eye of the beholder there. You can see whatever you want to see on that chart. The point is, it was definitively a breakout out of a multi-month, out of a 4-month range.
Yeah. And I think it's actually
4-month highs.
I think it's a big deal because I think that Powell has been driving the market lower with his tone deafness towards the autopilot. And he said a couple of things where he said that he would be listening and watching market for clues, and that's all it took. It didn't take him actually lowering rates. It didn't take him even saying he was going to lower rates. All it took him was him to get his foot off the brake. He has had his foot completely and utterly on the brake, pushing down as hard as he can, and he finally took his foot off the brake, and now a lot of these other things are so down and out they can actually rally. That's how I look at it.
And so here I have the chart on the junk bond, JNK, the high yield ETF from Spider. And it was interesting, Kev, I was way too early on this trade as well with members. I was holding a put debit spread on the downside of the JNK for almost the entire goddamn year. and the $34 strike was where I was sitting. And literally in the last week of December, I pulled the plug on it when the thing went in the money by $1. Talk about coming, I had the January spread with members on, and it just came through right at the end. Talk about a magic horseshoe shoved deep up my, I'm not going to say it on air. This thing, 2 months earlier, it was a write-off, and it somehow came through. But look at the reversal here, isn't it interesting?
Yeah, no, it's big. And you could think, actually, you should be sending Christmas cards to Jay Powell because he was the one who did that. And the real question I have to you
I'm going to give him a gift basket, not a Christmas card.
That's right. So I have a question for you. We asked Brent, do you think that he was more worried about inflation, or do you think he was more worried about bubbles?
Fed doesn't even know what a bubble is. Like, listen, there was. Did you ever get around to reading Ray Dalio's recent book, the free one, on understanding debt crisis?
No, I haven't, but I take it you did.
Okay, listen, pick it up. And you know what? Everyone gets intimidated by the fact that it's 400 pages, but it's only the first 60 pages that actually is the book. The other 300 plus pages is the case studies where he draws his conclusions from. So it's only 60 pages, and it's phenomenal.
It's easy reading even for you, Patrick?
It's easy reading for me. It's easy reading. It was great. And Ray Dalio in there makes a statement that basically is that the Fed should be managing bubbles, but instead, based on the mandate, they're focused on unemployment and inflation numbers, which makes them focused on the wrong things.
Right. So I have a theory that Powell is more focused on preventing bubbles than any other.
Oh, come on.
I do.
No. I completely.
Okay, well, that's what makes a market. I look at him. I can't believe that he was this kind of. I use the word tone deaf, but I think he's a smart man. So I think he knew what he was getting into when he kept hammering it down. And
I'm sorry. What? Tell me how the inflation numbers or jobs numbers in any way told him to take his foot off the pedal.
No.
The fact is that the market was turning lower, and the credit markets were turning down. He kept his foot on the pedal in the last meeting because he was staring at inflation numbers and jobs numbers, and rightfully so. The jobs numbers came out how? How did the jobs numbers come out?
But then why? So they were good. Then so why did he take his foot off the brake today?
I think that he just wanted to give the market. And something to kind of go with, right? Like,
no.
I mean,
so I completely disagree.
I bet you the next meeting he has, the language is gonna be more in line with December than it was what he said today.
Okay, so this is what I will bet you. I will bet you if the stock market and credit conditions of our financial conditions are looser and the stock market is higher, you are going to be correct. And I think he is managing. He does.
When's the next meeting? Do you know the date?
The next actual.
Type it up.
No, I know it. It's there's a meeting in between, but the next one that they're expected to hike, or because it's every second meeting, right? It's generally not every meeting. It's March 20th.
March 20th, but there's a meeting in early February then?
Yeah, I can get it for you. But that one is generally viewed as...
there's no press conference with that one. That's just a statement that's being released, right?
Well, I'm not sure because they did it January 30th. He's not going to raise rates on January 30th.
No.
But
it's the language. It's the language in the statement that's going to be everyone dissecting,
everyone tells me, they say he's raising rates so he can lower them later. I don't buy that argument. I just think that's
okay.
BS.
I won't disagree with
that. So I think to myself, he's a smart guy. Why did he hammer down on it so much? He was worried about the consequences of letting a bubble get out of control and then having another 08 type crash that ultimately costs our society more. Now, I'm not sure I agree with him, and I'm not sure that I think that he did the right thing. I'm trying to put myself in his head and understand what he's thinking. And to me, I think he's more worried about financial conditions than inflation. I don't think he sits there and... Okay.
I'm going to take the other side of your thing. I don't agree with you.
So tell me why he was so hawkish. You're telling me because he's actually worried about inflation?
I think that they're data dependent and they're looking at this data coming in, and I just feel that we have not yet seen U.S. economic data turn in a way that would force him to turn dovish.
No. But why did he continue to be so hawkish even as he saw everything collapsing?
Because I think that the Fed has to be consistent. I feel that if the Fed in any way showed that they're going to be sensitive, it would show that Powell is no different than Trump.
Okay,
that
so
every
I completely agree.
Matters.
Okay, so I completely agree that I buy that argument. But then why did he cave today?
Did he?
Yeah. he like
Well, the market definitely showed that it caved.
Yeah.
Listen, at least
I
the interpretation by the market is that it caved.
Yeah, I think he acknowledged that the Fed balance sheet unwind was no longer on autopilot.
Well,
And that's
you know
what-
Here's
that's all the
my
market
call.
wanted to hear.
Listen, we have an episode coming up very close to January 30th where me and you are going to take that FOMC and we're going to really take a deep dive into what we get from that. But here's my call. I think Powell put in the short-term low in the stock markets, and that bounce that we were talking about has finally got a catalyst. And I think that we're going to see a proper mean reversion of the sell-off. This kind of rally into January, February is very much likely to happen. You know, I was talking about it on Macro Voices, this idea that we'd go for a full double bottom retest, but I think Powell may have changed the course of that. And if that's the case, I still think we're going to mean revert a big way. I still believe we're in a bear market. I still believe at some point later this year the stock market is going much lower, but odds are the next month is probably going to be positive.
Well,
blue tickets.
so-
Blue tickets, Kev.
Blue tickets. I think you should be careful because bear markets are notorious for being sharp and quick, and then they drift lower again.
No, you know what? I'm sorry. Bear markets are prolonged events. Bear market should take 9 to even 12 months in duration. It's not a 1987 style market crash, Kev.
Yeah.
And
So I
think
agree
that-
with you there. But I think it's going to
so
drift
if it's
lower.
sharp and quick, then we should be down like crude oil 40-50%.
No, I'm saying the opposite.
It's over next month and we're done,
whoa,
right?
Whoa, no, you misunderstood me. I'm
Okay.
saying the
What did I
rally,
misinterpret?
the rallies are sharp and quick, and then they drift lower.
Yeah, no, the market will be like. Listen, I will. I don't at the risk. I'm not going to say I'm going to eat my hat because I have to do that already once.
Yeah.
But I don't think we're going to see 2,800 or something like crazy like that on the S&P. I think the market's going to pop, and you're right that it's thing. But I just don't think that the next sell-off happens in the next month or two.
Okay, so I'm going to leave you with one idea that I'm kind of
right.
tossing around my head. So this rally, like over the last few years, has been kind of strange in its kind of lack of volatility as it grinded higher, and people will say that's typical for bull markets, right?
Right.
I'm wondering if some of that has to do with the way that the nature of trading changing, meaning more VWAPs, more things like that. And I wonder if what we're going to see is the reverse, a grind lower that is amazingly orderly and just kind of does almost the exact opposite. It's like everyone that's bought it is going to put the VWAPs in the other way. Anyways, just something I'm thinking about.
I'm not opposed to that. Listen, bear markets are a liquidity. It's a period where the market is starved for liquidity, and so unless there's a catalyst to sell, it is a slow bleed. So there is a very reasonable chance you're going to be right.
Yeah.
That it's just going to be the lack of bids.
Yeah.
And every day people are trying to sell, and there's no one to sell to, and it just goes a little bit lower.
And
every
the
day.
algos are just in there VWAPing it out. Anyways, that's just something to think about.
So I'm going to leave it with this. Junk bonds in emerging markets. Over the next 2 to 4 weeks, are we higher or lower than this pop that we just got today?
I think we're higher. I think junk emerging markets, European equities, emerging markets, equities, I think that all those things will outperform the U.S.
On the short term.
Yeah. Oh, and over the long run, or the medium to long run as well.
Really?
Yeah, I know. But
you know what?
I'm going to get hate mail for that one.
All I have to say is over the long run, emerging markets are much cheaper and are probably going to, on a relative basis, outperform. But I still think that these things are going to get hammered one more time before there's a buying opportunity. So if you want to do a pairs trade, maybe you're going to be right on a pairs trade, like a long short combo. But I still don't think that this is a bigger picture buy the dip yet. I still think that there's more in this bear market, and I don't think that these markets are going to be safe havens by any means. Anyway,
okay. Well,
any last comment?
No, that's it. We should pull. It's been a long show. It's been great with Brent. We, once again, a big thanks to Brent for coming out and being our first guest. It was terrific.
Yeah.
Oh, actually,
so parting words of wisdom here, Kev.
Yeah. No, I did forget that there are one last comment, and it comes from Jim Rogers, and it's from a book, Inside the House of Money, which I think is one of the greatest books. It's a kind of a market wizards interview of different traders, and it often flies below the radar. But if you haven't read it, you should definitely take the time to go read it. And he says, Jim Rogers says the following. He says, "I don't know if the markets are smart enough to say, let's test the weak hands, but history has repeatedly shown that sort of thing happens. It's human nature." It's almost like he agrees with me on there's no bad tick. I chose the parting wisdom.
Almost
Yeah.
like if he did that. Anyway.
Okay, well, Patrick, it's been tons of fun. I've had a blast, and we didn't know how it was going to go with Brent, but I couldn't have picked a better first guest. What do you think?
Yeah, great pick.
Yeah, no, Brent's a terrific guy. He's honorary Canadian. I've always said that about him. He seems too nice. And actually, we found out he's from Nebraska. That's why he's such a nice guy. Those Midwesterners, they're always nice people. So anyways, thank you for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our free weekly email that will include a link to the show and the charts that we discussed. Rest assured, we'll never clog your email with junk, and we will only send you the weekly letter and updates for our upcoming shows. Also,
hey, listen, what did you think of this All or Nothing Brewhouse beer?
Well, I didn't like it as much as you because I only managed one. But
I'm 1.5. I'm gonna have to chug this last half of the can before heading out of here.
It was outstanding, and a big thank you to the All or Nothing and Brewhouse because it's been a terrific beer. And if you're interested in getting your brewery sponsored in upcoming shows, please reach out to us at markethuddle.com.
Also, you could follow us on Twitter at The Market Huddle, as well as you can follow Kevin at Kevin Muir and myself at Patrick Ceresna. And so thanks for joining us. Have yourself a great rest of the weekend, and we'll see you all next week. Thank you very much, everyone.
Thanks again. Take care.